Let's bring in Paul Christopher, Head of Global Investment Strategy at the Wells Fargo Investment Institute, along with Barry Bannister, Chief Equity Strategist at Stifel. A very good afternoon to you both. Great to see you. I'll come to you first, Paul, and just this uncertainty that we've got today created by these Truth Social posts around the Fed chair. Does it worry you that we're back to the sort of worst moments of policy uncertainty of the last couple of weeks, or do you think the worst is behind us?
Probably the worst is behind us, but we still have to see what happens with those sectoral tariffs. But, you know, these posts, these social media posts, they have echoes. They are an echo of the same kinds of posts that we saw about tariffs. And so having seen those posts and then the tariffs that arrived, it does put some doubt into the minds of some investors about what exactly the president will want to do in terms of trying to control monetary policy as well as fiscal policy and tariffs.
Barry, equally, what was your takeaway from what the Fed chair did say yesterday? And did it worry you? Did it concern you that it sounds like we won't get preemptive interest rate cuts?
Well, I think they're just echoing what we all know, which is that the environment is uncertain. But keep in mind that the next meeting where we do expect a cut after some trade deals and after better inflation data, the middle 2 months of the year, is June 18th. That's 2 months away. It's only... it's been a couple months since the market peaked in February, and that feels like an eternity to me.
What is your latest call, Barry, in terms of S&P 500 for the year ahead? Do you think we've had the worst, or is it pretty risky from here to be increasing exposure?
Yeah, we entered the year with a 5,500 target for the end of the year. I think the street was about high 6,000s. And other than an attempt to play, and we got 99% of it, but an attempt to play that relief rally off the March 13th initial bottom, it bounced pretty hard. And then, of course, the Mexico-Canada blew up, and the rest was history. But we've stayed with 5,500. That is our view. And we've been in defensive value, which is more of a stagflation trade.
Talk me through some names that would appear in the defensive value bucket.
Food, beverage, and tobacco primarily, along with healthcare, equipment, waste managing companies, and gold. These are all beneficiaries, for example, of stagflation, even if it's a mild case.
Paul, in terms of this debate about the risks ahead for the U.S., you talked about the way the tweets could worry investors. Does the S&P 500 warrant a lower P multiple today compared to a month ago, and by what scale?
Oh, it probably does. And certainly, if you go back even to September, October, end of last year, it does. But we've maintained that for some time, the multiples on tech, which really drove the overall multiple, that those were too high. And so we think those multiples have come down quite a bit here. And we really like quality here. And so we picked up tech, IT, to join with communication services last March, a month ago, as a value play. Well, more like a quality play is what I mean, going forward. You don't know where the bottom of this market is going to be, and tech and comm services might participate in some of that downside, but we do think those longer-term trends are very positive for those sectors, and so we like much better the multiples that we're seeing today versus even those of a couple of months ago.
Paul, are you getting clients asking you more about international equities over the course of the last few weeks, and what's your answer to them when they ask you if it's better than the U.S. at the moment?
Yeah, we do get those questions, and we've had them especially since the beginning of the year. But look, Europe still has important structural problems. They're overregulated. They have a desperate energy problem that they still haven't solved. President's offering them a potential partial solution. Let's see if they take it. But energy is a big problem for them. And it's one thing to say, hey, you know what, we're all going to spend 2% of our GDP on defense, but can they all afford it? If you start seeing France ramp up borrowing, what happens to those government bond yields, and then what does that do to capital formation in the French economy? So we are very skeptical that Europe is going to be able to come through with this determination so recently expressed of being able to spend more.